Well, I'll leave that question up to the healthcare professionals. But there's no doubt that we're in a worse situation today than we were about a month ago. We are seeing more cases pop up, and the worry now is being that the cases have been popping up outside of China. So we've seen cases in Italy popping up, Korea, Iran, and the latest worry now is that we're seeing more cases popping up in the United States, and that's what's got the markets a little bit more nervous now than it was a month ago. And there's no doubt about it that we have seen a pullback in markets. And actually, we're now in correction territory, which means that markets have dropped more than 10% from their highs. The question now becomes have we actually lost permanent earnings, or have some of the earnings just been deferred to another quarter or two? And our view is the latter. We do see from a fundamental perspective still that the markets are still sound, and the drop that we've seen from the correction standpoint is really more tied to the virus. But we still haven't seen the true impact of the virus into the underlying numbers. So we do want to see that before we think it is more of a sound pullback than what we might think is maybe a short-term noise versus a longer-term perspective. And we are long-term investors, so we are seeing good opportunities here, again, from a long-term perspective. That being said, I don't have any concerns with people potentially looking for protection in the portfolio through either hedges or buying low volatility stocks, given the current market conditions. What might calm markets, first of all, is going to be, do we see a slowdown in the number of cases being formed outside the United States, right? Because obviously what we have seen in the last month is increasing number, and that has caused our markets to be very, volatile. So if we do see a calming influence there, then that will likely tell investors that what we're seeing in the coronavirus is a short-term impact versus a longer-term impact on the permanent part of the earnings story. So that definitely is the most important thing that will calm markets. The second would obviously be the Fed. Will the Fed step in and cut interest rates as is expected? Now, last week we did see the Fed step in and say comments that we would do what would be needed if we saw a significant pullback in the economy. So there was some sign that maybe the Fed will do what it takes. But we do need to see that be realized, in the coming quarters as well, similar to what we saw in Q1 of 2019 after markets fell off in Q4 of 2018. So we still remain very, very cautious in how we're dealing with our portfolios. But we are looking at obviously opportunities in the marketplace. And so what we have done is definitely added some risk to our portfolios, but also adjusted some of our allocations in the bond side. In particular, we feel the US economy still has the best fundamentals. So when we've added risk, we've added to the US equity market. And in the bond space, we've actually sold off some of our bonds and put in cash. And the reason for that is that we have seen exceptionally low yields that we don't think are very attractive at this stage. We'd rather hold some cash because we do see still further downside in the markets, and we want to be able to have cash on hand to make those purchases. Yeah, if you think back into Q4 as an example of 2018, we did see a major pullback in markets. And what we saw fall out in Q1 and thereafter was a big rebound back as the Fed stepped in to calm the markets. We could see a similar situation play out here, right? If the Fed steps in, we could potentially see another pullback in markets. So that's something important to keep in mind. But that being said, you still want to have a solution that is focusing on balancing the upside as well as the downside. So you want to have equities and bonds in your portfolio. And a solution, that has a combination of that is the right mix. And we've seen that tested through time and time again, a well-diversified portfolio that has a combination of the rewards that markets can get if they move up, but also the balancing characteristics of minimizing the downside should we have situations like we're facing today. The most immediate thing we're watching right now is how much does the coronavirus continue to evolve. Will we see more cases popping out in the United States in particular, or in other parts of Europe? If we do see that, then there's worry that this is not slowing down, but maybe picking up some speed outside the most infected area, which was China. So that's the one important thing to keep in mind. If we do see some slowing down there, and we've already seen some slowdown in China, then that maybe is good news for markets that this thing is contained and we have some good upside movement going forward. And of course, we want to pay attention to the political party situation, right? It depends on who wins the actual election down the road. Will it be Trump? Will it be the Democrats? And important to keep an eye on as this polling continues to pick up over the next 6 months, and where is the market reacting to that information. And that's going to be very critical to see how you want to position your portfolio, particularly within certain sectors of the markets.